Hello, everyone, and welcome. Thank you for joining us for this OMFIF Live on global financial stability, digital assets, and the next generation cross-border payments. Today, we'll be looking at the progress made towards the G20 cross-border payments targets, the challenges around implementation and monitoring, and the opportunities presented by innovations such as tokenization. We'll also be discussing the evolving role of stablecoins, the current state of global regulatory alignment, and what divergence could mean for financial stability. So we're absolutely delighted to be joined by Martin Moloney, Deputy Secretary General of the Financial Stability Board. Martin brings a huge wealth of international regulatory experience. Before joining the FSB in September 2024, he served as Secretary General of IOSCO. Prior to that, he worked in the Jersey Financial Services Commission and the Central Bank of Ireland. Martin, it's a huge pleasure to have you with us.
It's a pleasure to be here. Thank you for asking me.
Thank you. So we'll spend the first half of today's webinar in conversation with Martin. We'll then be joined by three leading industry experts to share their perspective. As always, you can submit your questions in the chat throughout the session. Thank you to a few of you that also sent them in before, and we'll do our best to address them during the Q&A. So Martin, let's start with the big picture. We've recently crossed the 5-year milestone since the G20 cross-border payments roadmap was first launched. How would you assess the progress made, and how would you categorize the state of play?
Kellyanne, thank you for setting this up. I think this is very timely, and I'm hoping that by making some slightly extended opening remarks, maybe I can give you all a good sense of what's on our mind, and that my fellow panelists can then add further to, I hope, to inspire your audience to be part of a debate over the next year. It's one that I think we really need. Let me start by recalling, as you have, that it was 2020 that the G20 launched our roadmap. And the goal that has now become something of a mantra, I think, it was to make cross-border payments faster, cheaper, more transparent and inclusive. And it sort of rolls off the tongue, but making it a reality has proven really quite challenging. We understood, I think, from day one that this was going to be difficult. And to calibrate the ambition and try to create a degree of accountability, in 2021, we actually asked the G20 to endorse a set of global quantitative measures, most of which are set for end 2027. And those quantitative measures of what we are trying to achieve now tell us we still have a long way to go. And with the end of the roadmap approaching, we have the opportunity to reflect on what we've achieved so far and what further steps would be helpful. And I don't think it's just for the FSB to ask those questions. I think that every other stakeholder as well needs to do so. We still have work to do under the current roadmap. We won't get distracted from that. But I think it's time to ask all our stakeholders to begin thinking about the lessons that can be drawn. And I also suspect the history of the roadmap itself is full of lessons for us. The simple fact that we've had to update and reset the roadmap a number of times is itself pretty striking. This has not proven to be plain sailing. And just to start the discussion, let me point to a number of reasons which seem relevant to why we are where we are. The first challenge has to do, I suspect, with market structure and incentives. People will have different views. Payment specialists, of course, think their work is the most important in the world. But cross-border payments are somewhat marginal to the business model of many of the businesses who provide the service. Furthermore, the sense in which there is a traditional competitive market driving quality and innovation seems limited, because those markets are complex. Indeed, each major payment corridor sometimes seems to behave like its own market with distinct frictions. Regions appear to behave differently from each other, and so on. So we can talk about global cross-border payments, but it's more complex than that phrase actually suggests. Secondly, I think we face what I might call exogenous dependencies. For example, it's become clear that cross-border payments rely heavily on foreign exchange markets, which are the largest markets in the world and outside the remit of our roadmap. Thirdly, technology adoption dynamics are obviously important in cross-border payments. We are constantly told there is immense technological potential for efficiencies and new services. But it remains a fact that the market is dominated by participants who often appear to be seeking second or even third mover advantage. Finally, the necessary political and regulatory authority is very widely distributed. There is no global authority with a mandate to make this work well. Even at the domestic level, there is often limited effective coordination. Importantly, the issue cuts across the sensitive division of responsibilities between central banks and finance ministries. At the same time, there are many global standard setters and organizations with an interest, and we've tried to work with all of them. Adding all that up amounts to a real challenge for policymakers. On the one hand, it seems we may not be able to rely as much as we hoped on competitive markets to resolve issues, even if we do everything we can to make space for competition to work as well as it can. On the other hand, we haven't got well-established global authorities to direct change. So neither the visible nor the invisible hand seems to have a strong grip on this issue. But it's far from hopeless. Why do I say that? I suspect the FSB back in 2020 did something really important in trying to find a way through these challenges. When we set up the roadmap, we brought in an important simplifying idea, which was use the FSB's convening power to smooth out as many as possible of the regulatory and policy impediments to see if market dynamics to improve cost, speed, and transparency and access would work. We have done that. It was important to do it. The thought was, let's test what competition can achieve. And as we move towards 2027, however, we now have to ask the difficult question of what the results are telling us about that approach. Has our focus on removing frictions been sufficient? Should we double down on it? Should we pivot to operational planning, such as we are currently testing with our jurisdictional and regional action plans? Or should we just step back and let the technology innovators lead? Let me turn first to the technology innovators. A much talked about option is whether stablecoins could be the silver bullet. And we should talk further about this in our conversation, I think. But let's just remember the numbers. There are varying measures of the volumes of cross-border payments, but a figure of around $200 trillion in, let's say, 2024 is probably a good estimate. In contrast, the volume of cross-border payments being made by stablecoins is estimated to be only a fraction of this, maybe as little as 0.2%. So that's a pretty small fraction. The overall magnitude tells a clear story. Today, stablecoin volumes remain a very small share of total cross-border flows. There is some evidence of exploration of large financial institution use cases. Maybe the most immediate value might be for stablecoins as components of hybrid models integrated with bank money and interoperable FX settlement, rather than as a standalone global rails, maybe. But neither option is more than a possibility at this point. If you turn to our work to reduce frictions, the work has not just been about getting better policy frameworks, it's also been about technical frictions. So let me spend a moment on that. Poor data quality and limited standardization of data exchange makes cross-border payments more complex to process, in turn affecting their speed, price, and transparency. We know that. Promoting the adoption of common message formats, including conversion and mapping from legacy formats and the use of legal entity identifiers and common protocols for data exchange, all that does mitigate the frictions. Now, when ISO 20022 was first introduced in 2004, it marked the beginning of an important journey towards a new era of simpler, more data-rich payments for banks and their customers. One of our original building blocks in our roadmap in 2020, I think it was actually building block 14, was adopting ISO harmonized message formats. Now, 20 plus years later, after the original version of the ISO standard, we are at 77% of fast payment systems and 53% of real-time gross settlement systems reporting implementation for the messaging standard. Now, this is good, but it's taken a very long time, and it's not complete. Without the extensive work of CPMI, I suspect what has been achieved would not have been achieved. We also know implementation is necessary, but it's not sufficient. The value of the ISO standard comes from consistent usage, ensuring rich data, and embedding the standard into end-to-end operations. For example, screening, reconciliation, and fraud analytics, supervision. So it's not just about message conversion. So extensive efforts here have undoubtedly made a difference, but to fully realize the potential benefits of the ISO standard, continuous development is needed to align the messages to evolving market practices and to embed them into operations. For example, while ISO 20022 includes enhanced data elements that can strengthen AML CFT measures, a recent study found that many financial institutions continue to rely on traditional screening methods developed for payment messages. ISO 20022 carries more data than legacy messaging formats, so banks could use it to create a fully integrated payments experience, giving them an end-to-end view of operations from initiation, delivery of the payments, to exceptions, investigations, and reporting. But this requires large investment. Our work has also highlighted other challenges where we have sought to promote better practices, but we continue to hear about issues. Data sharing to fight fraud, smooth processes where capital controls exist, efficient ways to do sanction screening, how FX access restrictions work, payment versus payment coverage, opening hours. How do we get from identifying frictions to global implementation of solutions to those frictions? One of our key reflections is about leadership and regional organization. This is an area that the IMF and the World Bank have done a lot of work on. Don't jurisdictions need to carefully assign responsibility? And don't regions need effective regional cooperation structures if we're going to make progress? So my overall view is, look, we're coming to the end of the roadmap, but definitely not the end of the journey. The roadmap's goals surely endure. Perhaps the lesson of recent years is that coordination is proving to be the scarcest resource. So as we look beyond 2027, the question is not simply what we do next, but how we choose to organize ourselves to do it. Is continued friction removal enough to unlock better outcomes? Or do we need corridor by corridor or region by regional operational plans with clear ownership? If neither path is sufficient, what length would be credible and politically stable across jurisdictions? How far should we push standardization or integration without eroding domestic policy options or privacy protections? As technology evolves, back to the first question, should stablecoins and tokenized deposits be complements with integrated models or catalysts for new rails? But who will be the champions of a second roadmap? And finally, what should success look like after 2027? Not just in terms of metrics, but in lived experience for people and companies in every region. Maybe speed, cost, and transparency are not all equally important to end users. I think we need the help of every stakeholder in the system to reflect on where we are and what we should achieve, to convene discussions like this one, to send us submissions, to engage with us and with each other, to make sure a further roadmap really drives forward to substantive change. I hope to hear a lot more of these questions today and over the coming months. Thanks for giving me the opportunity to do some opening remarks.
Thank you, Martin. That's such a huge wealth of food for thought and a wonderful opening to allow, I think, the industry to reflect. I wanted to hone in a little bit on the targets, but actually, given what you've said, I wanted to pick on the point you made on whether, speed, cost, transparency, and access are really suitable targets as a global sort of metric scheme. I think this is really fascinating that one of the conclusions that you've drawn is actually because regions are so diverse, because corridor-specific issues are so prevalent, actually this type of metric that's been used, these KPIs, perhaps are no longer going to be useful going forward. Is that a fair summary?
I think I'd put it slightly differently. I'm absolutely clear that they're all important. It's just the question if you have to make a policy trade-off, and we have to ask ourselves whether there are policy trade-offs to be made in a further roadmap. Which one would you do first, and which one would you put further back? I wouldn't walk away from any of them personally, but I don't want to preclude the debate. Let other people have views on this, but that would be my instinct, I think. It's been extremely useful in this first roadmap to set up all three and to keep measuring all three so that we really understand that even when we see some good news in relation to one metric, we need to counterbalance that with looking at the others. That's been very helpful. But if we're getting to a point where we're doing a different kind of roadmap, where we have to make trade-offs, then I think the question is, which one is the most important one? And I'd add another point, which is, to have to answer those questions, policymakers is sometimes problematic because you kind of like the market to answer those questions. You like people to answer those questions with their feet. They either go to the cheapest provider or they go to the provider who is most helpful to them in explaining what's going on, or they go to the provider who get it there within the hour or whatever. Let people have their own views, and I suspect not all consumers would have the same priority list, and it's very helpful to have the market to help you work that out. It's a little uncomfortable to have to make that choice at a policy level, but perhaps we do.
Yeah. And just on I think cost specifically, if we look at you mentioned they're still important, and as you say, the FSB's done such a huge amount of work that helps us hone in on them. Everyone still talks about cost being a problem, and I think in your latest review you did mention that this is still the hardest to crack for remittances and some retail payments. So could you just expand a little bit on why you think that still is?
I think that's a very hard question to answer, but at a broad level, I think there's two elements to the answer. One is just to note that our data does not show a consistent picture. We actually show some good figures for some areas. Indeed, for quite a long time, there have been good figures for some areas, for some regions, and significantly worse figures for others. And sometimes you can, even within the same region, you can see different corridors where the pricing is significantly different. And it does seem to be an indicator that within this sector, price competition, whatever about competition broadly, price competition is not always the driver. And I think you can kind of understand that in terms of people's priorities. Just if I think about individuals going to get payments done, you can think of different classes of individuals having different priorities, and sometimes they're willing to pay quite high prices for the other benefits that are available to them. But sometimes perhaps they just have no choice. And all the payment rails that are available to them locally are priced very highly. And perhaps sometimes that's actually why they're priced so highly, because they're the only payment rails available to them locally. So it's quite a complicated picture, but certainly it is very important to us to note that we have not made as good progress on price competition and pricing as we would have wished to achieve. It's proving harder than speed, but perhaps a little more tractable than transparency. So if you try to order them in priority, you would have to say we've made some good progress on speed, not so well on cost, transparency, perhaps the least successful. I don't know if other people would agree with that, but that would be my sort of rule of thumb, at least as I'm sitting here.
Well, and on that point, I suppose, and on your previous point about how they all interlink with each other anyway, what would help with the cost situation is a greater access of new players, new competition. So that would feed into that result.
Your question is, if there was greater access, would it solve the cost issue? Is that your question? Yeah. I think I'm not even entirely sure on that point, because, to really analyze this, you almost have to do it segment by segment, and you probably need a team made up of competition economists, financial economists, a few social geographers, and the odd sociologist or two, in order to analyze this problem. Because even if you say, right, better access is the solution, you sometimes find that doesn't work, because people have so to give you an example, if I talk about remittances, let's say, you start thinking about how migrants behave. And very often the sociologists will tell you migrants go into groups, into subgroups in a new society in order for greater security and safety and so on. And one of the things I've noticed with payment mechanisms is that they can become associated with particular migrant groups. So a particular payment company is targeting a particular migrant group, and they're comfortable with that provider. They trust them. They know they have a good network in the country that they've migrated from, and they know that they'll be able to deliver, and that whoever they're trying to send their remittances to will be able to get it. So sometimes you get forces like that coming into play. And even if somebody new comes onto the market, they'll be a bit skeptical. They'll be thinking, no, I think I'll stick with the familiar. This is money. This is money going back to my family, let's say. I'm not going to just go to somebody who turns up with a brand name I don't recognize just because they say they're cheaper. You can get, as the economists will tell you, some slightly perverse effects sometimes, that if somebody is cheaper, people will assume they're less reliable. All sorts of things like that come into play here. So again, we're back to the complexity of this and the need to listen to people and break the market down into segments and understand the different policies may be necessary for different communities. The small business to business market may be not quite so conservative, maybe more willing to look for price competition, for example, and maybe that in that population you might be able to get more sensitivity to price and more willingness to move, particularly if there are some people who are willing to take the lead and prove that it works and so on. People are probably more comfortable with payment mechanisms that they have received payments successfully from, thinking, okay, I can get money out of this, so if I'm sending money to somebody, they'll probably get it as well.
Yes. Yes, the behavioural side of it is fascinating. You're right. We need some more sociologists and behavioural economics to step in now. I really like that. Yes, very interested in your point on, yes, transparency is the least successful. We were at a Project Agora announcement a couple of weeks ago, and something struck me about that this project is very focused on improving transparency across the board. By its nature, it's a shared ledger, so it helps with transparency. So it would be useful to hear your views on Agora, but technological innovation more broadly, and how that can really help with the wholesale payment side. Do you see these kind of initiatives as fixing the remaining problems in wholesale payments?
I really like Agora, I have to say, and I think it's really interesting. One of the things I really like about it was it brought together tokenized central bank reserves and bank deposits, right? And it showed that can work seamlessly. It showed that atomic settlement can work seamlessly. So it basically gets rid of the counterparty and the settlement risk, and says that is not an overwhelming problem. They actually did the work of going into the legal requirements in different jurisdictions and figuring out how to make sure they were compliant with all of those. Now that's a lot of hard work, but they showed it could be done. And they brought together 40 different major regulated financial institutions into the project. So they also kind of dealt with the critical mass issue. A lot of people will often tell you critical mass is the big problem. You've got one entity trying to go its own way rather than trying to do it with others, and often that leads you with problems. So there's a lot of aspects of Agora that are really successful, and they do answer some of the criticisms or challenges or concerns we often hear. Oh, I've got to deal with very complicated legal frameworks. I don't know about the settlement risk, and this way of doing things doesn't work for me. And as I say, I'm trying to do this on my own and nobody's going to do it with me. So those sort of objections we often hear. Agora is pretty good, I think, at saying, come on, those are not actually fundamental problems. You could actually make progress with those. But then you have to ask yourself, and it'll be fascinating to see, well, what happens next? So it's as if the Project Agora has sort of done its work, but then what happens next? And the kind of concerns I was expressing in my opening remarks about market dynamics and competition and whether there's a motivation there for people to actually invest and build technological solutions, that is, it seems to me, the open question that we have to think about for the second roadmap. Because Project Agora takes the horse to water, but is it going to drink or not? And I don't know the answer to that question as we sit here, but it would be great if one of that project, or indeed one of a number of other projects that BIS has pushed for to try to make progress in this area, if they actually help the industry to get across some of these coordination problems and some of these innovation problems that the more traditional industry are clearly wrestling with and can find very difficult.
Yeah, I think that's a very useful and comprehensive explainer of what it can do and what it should do going forward. Thank you. So let's look a little bit at stablecoins now. You rightly pointed to sort of managing the expectations and the current kind of volumes that exist. The FSB's done quite a lot of work on this already. I think in 2023 you published a framework and recommendations. We also have Dante that's joining us in a moment, and we'll get his views on kind of the current arrangements. But from your perspective, where have current regimes fallen short? I think the FSB did a lot of work on these set of recommendations, and we have seen a few jurisdictions work on them and develop them, but where are we falling short?
Yeah, by the way, myself and Dante were on a panel, was it last weekend, Financial Stability Institute panel. We had a great conversation about stablecoins, so happy to continue that here today. And it is interesting to ask yourself, what is really the problem at this point? And the regulatory problems and challenges are only one of them, it seems to me. We did a report in 2025 where we showed that a lot of the regulatory frameworks that are emerging are focused very much on AML CFT issues. And that's kind of understandable. That's where a lot of the politicians and the media and the public concern is around AML. But if you're going to build, we have argued, you build a framework that will deal with all the issues that can arise, the solvency issues, the financial stability issues, and so on. Build a framework that is comprehensive, that allows people to report in an efficient way their regulatory information, and allows good inspections to be done, and so on. And we've listed that in our 2025 report, covering about 25 different jurisdictions, a whole range of weaknesses and issues that are there. But to be honest with you, I don't think it's the concerns around the weaknesses of regulation that are the fundamental issue here. I think the fundamental issue here is a business model issue, and it's about whether stablecoins are going to really break into the payment space or not, or whether they are going to remain as a bridge between the crypto world and the fiat currency world. And that's may or may not be related to whether they stay as predominantly dollar denominated or not, but I don't see that as the critical issue either, to be honest with you. I see the key issue as creating functional business models outside where stablecoins came from. And that's a challenge really for the industry. And I would hope that insofar as the industry tackles that the regulation does not get in the way. And I think to achieve that, one of the key things that I think we need to push for better is a better coordination between supervisors and regulators around the world. This is an inherently global business. It hasn't emerged in individual jurisdictions. Even if stablecoins are predominantly in dollars, they're held across the world. And we need to have regulatory frameworks which are as seamless or nearly as seamless as the coins themselves in their ability to deal on a global basis with these issues. That is the one issue that I particularly have some concern about. We have long established traditions as regulators and supervisors about how we cooperate and we talk to each other. And, sometimes it works well, sometimes it works not so well. But this is one area where we have to be on our top game. I think we have to be really able to coordinate and cooperate globally to make this work.
Martin, what would you say are some of these risks of global stablecoins? So you've got these stablecoins operating cross-border. What would you say are the risks to reserve management, all those sort of things?
Yeah, one of the areas that particularly concerns our members is certainly the question of multi-jurisdictional stablecoins. And if you have if you don't have deference, if you have a requirement in a particular jurisdiction to have a local reserve, then you have a situation which is inherently a bit unstable. And not saying don't have that requirement, but I'm saying if you've got it, then we have to recognize that it's an inherent source of instability, and there needs to be a lot of working together between the relevant jurisdictions to make that work. That is certainly one issue. I think it remains the case, and we've seen this in the past in other areas, that regulatory arbitrage is still a key issue. If we have major stablecoins that are locating themselves in parts of the world where they expect to get or do get a lighter form of supervision and regulation, then that's not good for the global system as a whole. It's not good for the holders of those stablecoins around the world. And frankly, it's not good for the major jurisdictions whose currencies are being used. So, and indeed, in whose currencies the assets of those stablecoins are denominated. So you need to ensure that you don't see any significant regulatory arbitrage around the world. And we're in a process of getting there. I'm not sort of ringing an alarm bell and saying things are terrible at the moment and it's all gone too far. But I think we have to continue to keep an eye on those goals. Good cooperation, avoidance of regulatory arbitrage, reconciliation of regimes so that they work well together. Those, seems to me, are the key points for this, as I call it, inherently global sector.
Yes. Do you see, though, any benefits of different regulatory regimes developing so then you can see what's best? I've often heard this argument come in industry conversations where they say, actually, there's a period of time with innovation where sometimes it's good to have different regimes doing different things because then you develop different best practices. Of course, the regulatory arbitrage risk is there, but sometimes that pays off. I'm not saying it does, but I've heard the argument said.
Yes. I mean, I think it's an interesting point. And we're in the slightly unusual space here as regulators that we got out relatively early in relation to stablecoins, and we put our principles out in 2023. Indeed, did earlier work in 2021 on them, and IOSCO also did work on them. So there's always been for a long time, I would say, there's been a good global framework telling people what good standards are in regulation. But if you look at those standards, they still leave a lot of scope for individual design and different approaches in different countries. I think given where we are now with stablecoins, they're not themselves a major financial stability risk. They could be part of a set of dominoes that would cause problems within the systems, but they're not themselves currently at the size that would mean that if a stablecoin got into trouble, the whole global system would get into trouble. So we have a bit of scope for different approaches to be adopted. And indeed, even in relation to major globally significant banks, we see different approaches in North America and in Europe and so on. There's always some scope for different approaches. And I would think there's nothing wrong with that. When we aim to set out global standards, we aim to set them out in broad terms that leaves that differentiation open to jurisdictions. And if you look at I'd like to think if you look at our 2025 report, where we reviewed what different countries are doing, we didn't bang on the table and say, you're not all doing it the same way. We're not looking for them all to do it the same way, but we're just looking for certain guardrails and certain principles to be complied with, and a degree of common sense, even if you allow it to be done in different ways. So when I've talked about regulatory arbitrage, I haven't talked about let's all just put the stable coins in the major jurisdictions and not have them in other jurisdictions. No, you can have them, it seems to me, perfectly sensibly in different countries, but you just got to keep within some sensible boundaries in doing that.
Thank you, and useful, very useful. Thank you. I'm going to invite, we've got some really, really clever and interesting people on the line. If I could invite you to turn your cameras on, and we'll bring you into the discussion. We have Dante Disparte, Chief Strategy Officer and Head of Global Policy at Circle, Mike Truter, Global Head of Industry Engagement at Swift, and Jake Hartley, Director of Digital Assets, Barclays. Welcome to all three of you. I hope you've enjoyed the conversation so far. We're keen to bring you in now. Given we are talking about stablecoins, Dante, let's go to you first. Obviously, Circle has a very useful perspective, given you're operating, I believe, in both Europe and America, looking at Mika and Genius. So perhaps talk to us a bit about how do you manage these different jurisdictional requirements and what are the implications for your business model, as Martin was touching on.
No, thank you so much, Katie Ann. And it's great to indeed reunite with Martin. We had a great time at the Bank for International Settlements. And frankly, the fact that the conversation of stablecoins and payment systems optionality has made it not only to this august panel, but also to the 96th annual general meeting of the BIS really tells you a couple of things. One of them is that the category perhaps is too big to ignore, but no category in payments and banking is too big to fail. We should have learned hard lessons of 2008 and earlier examples in the past. And then secondarily, and then I'll answer your specific question, secondarily, the denomination of a payment is agreed to by the sender and the receiver. And oftentimes the technology is the easy part. And as I think Martin rightly described, the technology and the rails and the optionality in the system is in some ways patently easy. And the more you have rules-based competition, the better it ought to be for remittance corridors that are historically stubborn or money flows that are historically stubborn and costly. The real gap always tends to be organizational. It tends to be on the side of agreement, and now not agreement between entities and counterparties. We have colleagues from Swift on the line today, for example, but rather agreement between jurisdictions and regulators. And so one person's fully regulated payment stablecoin, which is the term of art the United States will impose on this innovation under the Genius Act, might be another country's banned dollar-based crypto asset. And so the inability to land a jurisdictional and regulatory agreement will always, in many cases, be the gap. So to your specific question about Circle and our business model, we obviously have aspired as a business to race to the top. Trust, transparency, accountability, auditability. Many will remember the era of internet funny money, or what I like to call stable and name only coins, where they spectacularly blew up under, for example, the Terra Luna example, an algorithmic stablecoin that blew up in the span of a weekend. We've always tried to race to the top when it comes to the bank-like features of stablecoin-based money and ensure that this was an extension of trust in the broader banking system and that it was providing the end user with redemption at par in all scenarios, even in a scenario where, for example, mid-sized banks in the United States face deep stress and duress. And so what that then leaves you with is the rails. And increasingly, I think that's the most important part of the conversation, is technology that could deliver fast end-to-end payments at a global scale, necessitating all the very coordination points that Martin rightly pointed out, but that's where we are coming to today. And so Circle does operate in a multi-jurisdictional construct. We are the largest regulated dollar stablecoin issuer here in the United States. The Genius Act is a new law that comes into force next year, but it is a very durable, prudentially sound law that would even impose upon a bank-issued stablecoin construct balance sheet limitations so they look more like Circle and less like a bank. And obviously, the Europeans came first. If you want to rally the American Congress and the Senate, tell them Europe is regulating dollars before the United States is, and you suddenly get a lot of bipartisanship. And so I pride myself in uniting Washington twice. Once in the dislike of the Libra project, and second in wanting to regulate stablecoins as a national innovation. And so, of course, under the rules in Europe, the markets and crypto assets framework, Circle ran to France, where most of the other players in this industry ran from Europe. We ran to the heart of Europe. And in Europe, the regime is actually very easy to understand. It makes stablecoins a near peer to electronic money. It requires that the reserves are held locally inside the European banking system. And so whenever someone says stablecoins equate to a flight of deposits, I would say look to Europe, and you have a crowding in of deposits in the banking system. And nonetheless, the activity now supports, the largest dollar stablecoin in Europe, and we're also the issuer of the largest euro-denominated stablecoin. One last plug, and then I'll pause. I think it's also important that we could look back to this last 5 years of global principled debate about what to do with this innovation, and actually give an applaud, a hearty round of applause to the regulatory bodies like the Financial Stability Board and others, because we've landed at a point where I think regulators are very well equipped at a national level to regulate the activity. Regulators are very well equipped to look at this from a technology neutral vantage point. Both the Genius Act and MiCA do exactly that, and to make the innovation a near peer to electronic money or banking and payments rules. So with those done, if you're interacting with a stablecoin that has failed to meet those regulatory standards, it's most likely the issuer chose not to be regulated, as opposed to the lack of a clear regulatory regime. And so with that, we have a pathway in front of us for the balance of the FSB roadmap and what we should do in the future that ought to encourage serious harmonization efforts and serious regulatory substitution and reciprocity efforts, because the innovation is fundamentally global, and a stablecoin fundamentally appears in an end user's wallet as a balance. And those rights need to be espoused and protected at the digital level so that they can be hardened to the best jurisdictions and not the worst.
Thank you. Dante, we've had a question from the audience, and I was trying to save them to the end, but I might weave them in given they're relevant. It's a good question. Someone's saying, if you don't want to comment on a specific country, that's fine, but we're being asked, what's your views on the Bank of England's 30% reserves in this, with the central bank? I think it's a good question. I think it draws to a difference between the UK's approach versus other jurisdictions. So if you have a brief comment on that, that would be great.
Sure. Well, one, I was honored to testify in the parliamentary inquiry at the House of Lords on stablecoins, and I actually wrote an article for the Financial Times encouraging the UK regime to get going. The United Kingdom has what I would like to describe as a second mover advantage, because it could take the best of the other side of the English Channel of what MiCA has put in place vis-a-vis consumer protection and market protection, and align also, of course, with the Genius Act and play to strengths, which is, such an important financial center. To the specific point about the Bank of England's regime, the Bank of England is getting it right. Very few central banks are as capable when it comes to payment systems innovations as the Bank of England. And they're getting a lot right, which is that the closer proximity a stablecoin construct has to the central bank, the safer it will be. And so this is where we have to all look at ourselves in the future and say, cryptographic tokens representing money or a claim against money are not really a breakthrough innovation at all. The breakthrough innovation is payment systems, it's the rails, it's constantly upgradable financial markets infrastructure. That's the breakthrough. And so the Bank of England, by saying you could get services from the central bank directly, what share of them are remunerated and all the rest is a different debate. But the Bank of England, in my opinion, is getting this statement right, and it ought to accrue to a national competitive advantage for the UK.
Excellent. And one other brief follow-up question, and then we'll move on to Mike, I think, to talk a little bit more on these last mile issues that we raised at the beginning. Just briefly, Dante, do you see use cases evolving for stablecoins in cross-border payments? Remittances is always talked about again and again and again. Any other use cases that you think we should have front of mind?
Yeah, well, first, we have to really look at the remittance case study, and for example, USDC in its 7-year history has supported global payments and dollar access in nearly 190 countries. And for little more than a basic internet connected device, you have millions and millions of end users, millions, if not hundreds of thousands of businesses and enterprises and others building on this financial services shareware. That's a very powerful breakthrough that in some ways equates to, there's a lot of analogies. I'll try to not overuse the old ones, but it does allow for this device-centric payment network to be established at world scale. The key is it has to be interoperable locally, and it has to be convertible either into the local currency or convertible into the local banking and payment systems. That's where all of these great conversations go a long way. But at the same time, it would have been wrong to dismiss stablecoins as merely poker chips in a crypto casino once upon a time and ignore this always-on global settlement innovation that they can help enable. It would be equally wrong to say that stablecoins aren't going to be eventually connected to an agentic economy, because software will default to settling with software. And virtually every major firm on the planet is trying to think loud and often and hard about what role they're going to play in enabling payments that are truly machine to machine and device centric, but where the counterparties are AI powered agents and others. I think that wave, I won't say the exact math, but not all AI payments are using stablecoins, but virtually all AI payments that do use USDC. So we see a lot around the corner when it comes to agentic commerce and payments that stablecoins can help support.
Fantastic. We look forward to, I think we should do another hour on that, perhaps in a few weeks, on agentic AI and stablecoins. Mike, let's turn to you now. Obviously, Swift is so crucial to this whole debate. Can you talk us a little bit through some of the research that you've done to address the kind of final speed and cost problems we discussed?
Thank you very much. It's a pleasure to be here with this esteemed panel. Yes, I think Martin's covered an awful lot, and he touched on some of the challenges that the G20 program for cross-border payments, improving cross-border payments, has covered, and also that link between speed and the other things. I think it resonates with me as well. That if you get speed right, maybe you're addressing cost and some of the other aspects as well. And the way Swift has done this in the past, I think when the G20 program started and we were thinking about it, we contribute the KPIs for wholesale cross-border payments as well into the reporting that's done. We thought so much about the interbank piece, just between the cross-border elements, the cross-border leg of payments, and spent quite a lot of time looking at what could be done on the speed of the cross-border leg. But actually, it led us to understand that maybe we were looking in the wrong place, because actually, if you look at the speed of the cross-border leg, it is already extremely fast. I think the figures we released last year, 75% of all cross-border payments reach the creditor agent within 10 minutes. You may say 10 minutes is too fast, but the target is to get 75% of all cross-border payments to the beneficiary within an hour, and that's probably the key place to focus. And so we thought about this a little bit, and I'm going to use a slide to share a little bit about thinking about this end-to-end journey. We went from thinking just about the cross-border leg between the debtor agent, creditor agent on this diagram, to starting to think end-to-end about the flow of a journey. And in 2004, 2005, we did 2 papers looking at the speed, the end-to-end speed. We call it the Spotlight on Speed paper, thinking about this journey. And what we discovered through that investigation was that actually about 80% of the end-to-end elapsed time is spent with the final financial institution in the chain. So we could think about this as the on-ramp or off-ramp, however we want to look at it, depending on the technology being used. But really, when we mention this word last mile, we think about the crediting of the creditor by the final financial institution. So not the rails to get the payment there. That obviously matters. That plays a big part, 20%. But actually, if we're really to achieve this speed change, a step change in speed, we need to think about what's stopping or what's preventing the crediting of the beneficiary quickly. And if we can solve that, we can fundamentally change the speed outcomes for the G20 program. And so that got us going down the next step of kind of considerations for how we would do it, and thinking about the structural frictions that remain. Last year, we did a study across 40 markets globally, 50% emerging economies, 50% developing economies of all shapes and sizes. And actually, we got from all of the feedback from those markets, we grouped things into what we call 5 friction areas or areas of optimization. And I'll quickly list them through, but regulatory reporting, so the obligations on financial institutions to report something about that crediting of that account or before they credit the account. The second, Martin touched on these, is the FX and capital controls. A third area is adherence to standards, which not just covers ISO 20022, Martin mentioned, but also operating hours as well, opening hours for the banks when people are processing payments. A fourth area is the AML CFT areas, risk frameworks. And the fifth one is domestic market infrastructure, which also matters as well. And what we did was we combined this with the last mile crediting speed, which we have from our universal confirmation data on Swift's network, to really understand what is the impact of each of these frictions on crediting speed. And I just quickly want to run you through the way our index kind of categorized the impact of each of these frictions on payment crediting speed. I'm not going to go into the underlying detail, but I will share a link so that everyone can see where these numbers came from. But our analysis showed that actually the way regulatory requirements are framed in a domestic market really has a huge impact on payment crediting speed. So again, the obligations on what has to be done by a financial institution before they credit. Likewise, capital and FX controls have a significant contribution over and above the underlying rails and adherence to standards. And if we think about just the bottom three parts of the payment optimization iceberg, as we call it, the bits that we don't typically talk about or see are having an impact of something like 6 hours of crediting time. Again, the last mile is really with the final financial institution. If we can find a way to focus our actions on unlocking that 6 hours of payment crediting time in the last mile, we are going to fundamentally change the ability of the G20 program to deliver the speed benefits and reduce, hopefully, some of the back office processing, the cost of the transactions as well. To achieve the objectives.
It's really striking research, Mike, and the fact that you said, I think the actual cross-border leg is done within minutes, whereas the beneficiary side takes several hours, is, I think, a really important way for us to all rethink how we talk about these issues. And I was quite also struck by, you said it depends on how the regulatory bodies are framing these requirements. So I always understood from Swift, you're not saying that less controls and less reporting is important because of risk management purposes, etc. But it's how they're framed that makes the difference.
100%. Yeah, and actually, this the study, the index, in the end contains information across 39 different markets, and it's exactly that. It's not a question of the controls are necessary, but how those controls are achieved can sometimes, we can learn interesting lessons from markets that are achieving the controls, but managing to do it in a way that allows the payments to be credited really quickly, reducing the costs and overheads as well. So there's something to be learned from the markets that are doing things in a way that enables speed to be the outcome.
And how realistic do you think is development in the next, 2 to 3 years, Mike, given we've now got this research to back it up?
I think it's very significant. Actually, we've got a playbook element. I've just shared the download if you want to look at the whole document. But we've kind of broken things up across 4 different groups of actors that we think have a role to play, and we've put a number of suggestions or recommended actions into that playbook that we think is useful for the market to be talking about. Maybe something that can go into the actions. The groups being coordinated by standard setting bodies like the CPMI and FSB to pick up those and act on them. We've got that key coordination and convening role that's being played at the moment by those bodies. Gives us a fantastic way to be able to pick up and address these on a global basis, so everyone benefits from the change.
Excellent. I'm going to bring in Jake now, because you've been patiently waiting, and as a bank, you have of course, has a fantastic perspective that we need to hear from. And then we'll address a couple of audience questions as a group. Jake, you've been in finality for many years, and now you're at Barclays. I think you can really tell us why we should be looking at these kind of newer settlement models. I'd be interested in your view on, Barclays is also part of finality, and I think you've invested in Ubix. So you're clearly, prioritizing the innovation leg of this. how do you see this solving like material issues to address the targets that we've been talking about?
I mean, look, I think that thank you for the session, by the way, and thank you for all the comments so far. I think from a regulated bank perspective, all of those initiatives you've mentioned are super important. What we're keeping in mind is what are the most material, operational and regulatory constraints, that are currently limiting those improvements in cross-border payment speed, transparency, and cost, and really looking to solve for that. So maybe I'll say a few words on that. I think that from a bank perspective, the question as to whether these technologies, these platforms, whether it's the ones you've mentioned or others beside, whether that they are there and available to move money faster, cheaper, and safer, I think that's pretty much a settled matter. And from my personal perspective, it's equally settled that the most profound benefits in payments innovation reside in that wholesale cross-border space. I think that the harder challenge is delivering those benefits while maintaining the safety, the resilience, the trust that the financial system requires, and that's really front of mind from a bank point of view. I suppose there are a few constraints that come to mind. I think the first constraint is, regulatory fragmentation. Cross-border payments are involving multiple jurisdictions with different rules covering AML, sanctions, customer protection, prudential treatment, even basic things like when does settlement finality occur. So I think that even when the technology enables real-time settlement, banks need that legal certainty that those transactions are going to be recognized and enforceable across borders. So I think that the lack of regulatory alignment can preclude that and create friction, complexity, and cost. So it's very good that we're having these discussions today. I think that the second constraint is the ever-present interoperability conversation. And look, I don't just mean technical interoperability, i.e., can one protocol talk to another? I think that payments are moving across a fragmented ecosystem of banks, of payment systems, of correspondent networks, and increasingly those new digital infrastructures that you've touched upon. So I think that what's needed alongside that is those common standards for messaging, for identity, compliance, settlement, which is exactly really what Mike was talking about, as well as those common technical standards, or at least technical compatibility. Without that, you'll be left with institutions being forced to maintain multiple connections, multiple reconciliation processes, which limits that benefits case. Again, I suppose all of this, besides from a bank point of view, you have these financial crime controls that remain non-negotiable. Banks are obviously still accountable for sanction screening, AML monitoring, record keeping, transaction traceability, kind of regardless of the underlying technology or regardless of the underlying platform. So I do suspect that real-time payments are going to require equally real-time compliance controls, which can be quite challenging when we're talking about the cross-border context. With all of that said, I do think we need to recognize that the future digital payments ecosystem is unlikely to be based on a single form of money. I think this has come up in some of the responses that have been given so far. Stablecoins, tokenized deposits, central bank money payment rails are certainly not, to my mind, competitors. I think they're complementary layers of the same system. Stablecoins can provide that reach, those global network effects. Tokenized deposits can bring the balance sheet and the regulatory framework of commercial banks to the table. Central bank money obviously remains the ultimate settlement asset, so which provides that foundation of trust and ultimate finality on which the broader system operates. So, I mean, in that sense, I definitely see each form of money enabling the safe scaling of the next. And I think I think in closing, I think the technology to improve cross-border payments does largely exist today, as does the benefits case. I think the real challenge from a bank point of view is achieving that legal certainty, that interoperability, and that real-time compliance at a global scale, while really maintaining the highest standards of safety and trust across new forms of digital money that the ecosystem is going to require.
Do you think, Jake, the real-time compliance is achievable? How far have we come with that? Whenever I'm talking about all these multilateral projects and various other initiatives, it always seems that compliance is this issue that we just can't solve. So real-time seems really difficult.
Certainly hard, and certainly I would say work to be done. I think that, again, speaking from a bank perspective, whether you're looking at new capabilities like tokenized deposits, like programmable payments, like interoperability with emerging payment networks, it has to be approached as control by design. And in plain English, I mean compliance, sanction screening, permissions, transaction monitoring. It has to be embedded directly in the architecture rather than added afterwards. And I think we are trying to integrate that from day one. There's going to have to be elements of a phased approach for certain. I mean, I don't think any bank is alone in testing new technologies first through, controlled use cases and ramping up towards business as usual. But ultimately, that's something that you've got wide representation on the call from different areas of the industry. And I think that it's important that we're going to have to try and solve these challenges together, really.
Yeah, and as Martin mentioned at the beginning, the investment from the banks is, of course, a difficult issue, and where to put your investment in new technologies and other projects and so on is always a challenge. We have some very interesting questions that have come through. We're probably going to run over a few minutes. If you have to dip off, let me know, but I think it's worth coming to them. Martin, you mentioned at the start that FX is kind of outside of your remit, which I thought was interesting. And someone sent in a question to us which said, how do we ensure a competitive FX market? Are there any steps that you've seen or that the panel has seen where we've made progress towards kind of a competitive and instantaneous currency conversion layers? Because this is kind of this big elephant in the room. I mean, Martin, perhaps you could touch on FX more.
I can a little bit, but I would say I'm at the limit of my expertise, I think, when it comes to FX markets, and certainly it's not something that we have looked at in any great detail for precisely the reason I said earlier. I mean, the point that has sort of really impressed me as I have gone, particularly to emerging markets regions around the world, is the challenge they often have in trying to get FX from one jurisdiction to, let's say, a neighboring jurisdiction, and the need to move it through a major global currency in order to get back into the local currency that's just next door, because they can't build the liquidity in the bilateral relationship to be able to hedge their risks and so on. So you start getting this costly intermediate step being introduced. And there is no obvious solution to that. I am not in a position to say, yes, we have the silver bullet that will solve that problem. I know I can imagine some people on the call saying, yes, but if we were the solution, we would be, that problem would disappear. Perhaps so. But all these things are interconnected. So as with a number of the other issues that have been mentioned earlier, it seems to me that how big a problem is depends on what the other problems are. So we have this sort of very path-dependent challenge in front of us. So if you go, let's say, a stablecoin route and you have critical liquidity and everybody's going into stablecoins, well, is that the same as everybody just going into dollars? Or are the costs and the frictions of going into stablecoins different than they are and going directly into dollars? I find it hard to sit here and say they would be very different. You get a lot of rent seeking in a lot of these systems, as economists would put it, and that is sometimes obvious, but very often it's linked to liquidity issues, and it's very hard to get liquidity in anything other than major currencies. And I'm afraid I hold my hand up on that and say I do not see an easy answer to that problem, unfortunately.
Anyone have any comments to add on that? It's a tricky question, Dante.
Yeah, I mean, my brief comment is, one, it would be worth defining what I think a stablecoin is in the context of a payment system conversation. And then two, I'll try to shed a little bit of light on the FX question. In the context of a stablecoin, stablecoins and payments are a unique innovation in part because they marry the settlement asset with the messaging instruction. And so everything we've discussed on this call, I think the great commentary from Jake and Mike and obviously Martin as well, really underscores the coordination mechanisms that all of the global payment networks introduce. And why stablecoins are breakthroughs in payments is because for the first time in my view, in the history of payments, we could have one common asset that is programmable, composable, divisible, device-centric, that marries the settlement asset with the messaging instruction. And for that, obviously, how it grows and how it scales, I think is going to be really, really compelling for a lot of reasons. Payment system competition, introducing competition in some of the world's most stubborn remittance corridors and all these other use cases, not to mention the machine-to-machine conversation that will be our next panel with OMFIF. In the context of FX, Of course, a lot of jurisdictions and a lot of countries are concerned with the rise of stablecoins for fear of this notion of digital dollarization or currency substitution. But in the context of FX, the more you have more of the world's key currencies represented as cryptographic tokens, the more even in FX you could introduce competition. One of the reasons FX is such a stubborn domain is not just the liquidity and economic issues that Martin pointed out, it's also for the lack of competition. And there are very few places and very few choices that people often have in which they can convert their currencies. But the more we get to the state of more currencies and more monies are represented as tokenized forms of money, exactly as Jake described, it could be from a multitude of different issuers, including public sector, the more then you could execute FX on chain. So that can be settled. And we've seen this happen already with our euro stablecoin and our dollar stablecoin, obviously. But the more you see more currencies represented on chain, the more you could actually introduce critical competition for FX as well.
Mike, Jake, any other comments before we move on the FX piece?
I think Dante and Martin have covered it perfectly.
Fantastic. So that someone has taken up your offer, Martin, on rethinking the targets and adding to them. The question is, fraud is a central concern for consumers and has a significant implications for cost. Why is safety treated as secondary to speed, cost, transparency, and access in the roadmap?
I think because the answer is because we haven't seen a significant challenge with safety, and if we had seen a significant challenge with safety, you would see us as being the first ones in the door, because financial stability is our main sort of point of reference. You know, we haven't seen that. There's a lot of work that goes on done by CPMI and CPMI OSCO and so on to ensure that you get good settlement finality and settlement systems and so on. The payment systems are robust. It is something that we would keep an eye on in a lot of other aspects of our work. But I think rightly so, it wasn't made. I'm open to debate with others on this, but rightly so, I think it wasn't made a focus of the cross-border payments roadmap specifically, because it would have looked like we were being asked to go back into what I would think of our core competence, which is in the safety space, where we were being asked by the G20 to move into new areas when the roadmap was developed. It's an interesting question to ask, and maybe something we should reflect on if it's still true and still going to be true in the period ahead, because you do see signs of fragmentation used within payment systems. You do see new risks emerging related, for example, to AI, and speed brings its own risks. So perhaps the speed issue needs to be looked at again and reflected on again. One thing I would say is the more goals you add to a roadmap, the less effective you make it. If you can strip down your goals and make it aligned with a clear policy objective, then you are more likely to be successful. So for me personally, it's a high bar to add to the complexity of our program.
Can I add a little something here, which was pointed out to me and I didn't appreciate earlier this year. It's speed, cost, transparency, and access, while maintaining safety and stability. It is actually included in the thing, just not as a target, but the expectation is the bar stays as it is, to Martin's point.
And Katie Ann, if I may, there's a famous, perhaps fictitious print shop in Cambridge that says you could have fast, high quality, economical printing, choose two. And I think Martin's opening remarks about the value drivers in a payment system is really, really powerful and will age well, because friction, speed, low cost, safety, soundness, right now, all of these things oftentimes represent competing goals and competing objectives. And what the technology conversation again has done is merely show where, you know, existing players might have fallen short, but technology alone is not the answer. You need other issues to be coordinated as well.
Yep. Fantastic point. I think we have time for one more quick question, and then we'll have to wrap it up. This is quite a topical one, and it always comes up. perhaps Dante is one for you. Why shouldn't stablecoin issuers have interest akin to banks? Stablecoin issuers offers interest rate yield akin to banks. So we know that this is coming up all the time. And perhaps Martin, your thoughts would be welcome, and Mike, of course, as well.
Yeah, well, first of all, it's a great question, and you know, the way I look at it right now is it's settled law with both the Genius Act and MiCA, and historically prior to the Genius Act and MiCA, stablecoin issuers paying interest directly to coin holders would have strayed the stablecoin construct away from payments and banking and into securities or commodities territory. And so stablecoin issuers that ignored those pre-existing rules did so at their peril. And for as long as I've been uploading the US dollar onto the internet, it was pretty obvious that those were some bright red lines that you didn't want to cross. In the United States, the Genius Act precludes stablecoin issuers from paying yield directly to coin holders. We need a secondary set of rules under the Clarity Act to address how this might also look in secondary markets. And the European framework under MiCA has gone the furthest, which is it not only bars the remuneration of stablecoins directly from the issuer, it also bars exchanges from paying any rewards or yields as well. These were innovations and points of friction that were put in place against the flight of deposit argument, and to ensure that stablecoins effectively lived in a domain of payment systems innovation. And so stablecoins solved crypto's original sin, which was hypervolatility of Bitcoin. And so in doing so, in order to inherit money-like properties, they have to hold price stability to the underlying reference currency. They have to be used as a medium of exchange, a store of value, and a unit of measure, which are the three features of money, but under the watchful eye of central banks and under deep partnerships with the banking system very broadly. So in our view, we are nonplussed by that requirement. We also think it's just important, if you want rules-based secondary market innovations, that the secondary market is able to innovate and take advantage of the other features of digital money, programmability, composability, divisibility, and so on, so that, again, people are incentivized towards introducing more forms of FX, for example, borrowing and lending markets. All of these features presume that secondary market innovators can build on stablecoins. And I would argue that banks, too, ought to be able to leverage these infrastructures to ensure that the banking system doesn't look vulnerable in the face of technology competition, bank and non-bank competition as well.
Martin, Mike, any additional points?
I mean, no, but I would just say I've watched the debate with interest. Our members have not sort of formed a joint or shared view on it. I just noticed that if you provide for stablecoins to provide interest, they get more and more to look like money market funds, and there are choices being made there by the legislators, and the choices they're making. I think Dante has summed those up quite well. But I also think the financial sector is endlessly innovative and dynamic, and in the future, who knows what we will see.
Well said.
I'm going to let you end, Martin. Perhaps you could just give us a final few words. If you could give sort of one, call to action to central banks, commercial banks, non-banks listening today. We've got a lot on the line, and thank you to some of you for sending your questions. But if you could just send out one call to action on, the future role of the FSB, the future role of the roadmap, what would it be?
So, perish the thought, but a cynical mind sometimes thinks that international bodies like ourselves go through the motions of consultation, and we're not really interested in what people have to say to us, and we have a preset agenda in our own minds. That's, of course, entirely untrue, and that never is the case. But in this situation, it is particularly not the case. I'm asking people to think about how they can contribute to a debate to do around a second roadmap really seriously. I think we are very open-minded about what that second roadmap might look like, and we are not inclined to take the view, well, let's just keep doing what we did already. There's a definition of that about doing what you did already, expecting a different outcome, which I won't elaborate on, but that's not what we're inclined to do here. So we would ask people to take us seriously. I hope organizations like Mike's and Dante's will take us seriously on that and really reflect carefully on what would be helpful to us to figure out what's the best advice we can give the G20 on how to really take the step forward. I think for me, at the end of the day, this is all about the end users, those small companies and those people trying to make remittances and trying to get them the kind of service which, quite frankly, they deserve. And given the developments that you're seeing in domestic payment systems, the contrast between cross-border, despite the improvements in cross-border and domestic, is just striking. And we have to do everything we can to help them. Thank you.
Thank you, Martin. We really look forward to helping you devise that second roadmap. We will avoid, I think the final quote of what you were saying was, the definition of insanity is doing the same thing again. So we'll avoid the insanity from doing the same roadmap again. But no, I think your invitation to others to help define it is truly admirable, and you have been fantastic with your reflections and insights. So thank you so much, Martin. Thank you so much, Dante. Thank you, Mike. Thank you, Jake, who's had to leave us because he had a hard stop. But it was a fascinating discussion. Thank you to everyone who joined and those who interacted with us with some questions. We hope you found it insightful. We look forward to seeing you at another OMFIF DMI event soon. Have a great day, everyone. Thank you.
Thank you all. Bye.